Good morning, my students, and welcome to our first lecture in current issues in banking and finance. I'm Dr. Magda Mustafa Sadiq, Associate Professor of Economics at Sudan International University. In this course, we examine how global financial architecture is evolving to meet 21st century realities. Today, we begin with a topic that lies at the very heart of modern financial reform: sustainable banking. Over the next few minutes, we will look deeply into how financial institutions are shifting from traditional profit maximization models toward comprehensive long-term value creation. To truly understand sustainable banking, we must first examine the historical baseline. For decades, commercial and investment banks operated under what economists call the shareholder primacy model. Under this framework, a bank's primary metric of success was short-term profitability, return on equity, and financial performance. Environmental degradation, carbon intensity, and social inequality were viewed as external factors, issues outside the bank's core balance sheet. However, the global landscape has shifted dramatically. Systematic climate risk, resource depletion, growing social inequalities, and rigorous international regulatory frameworks have fundamentally redefined societal expectations. Today, generating an operational profit is no longer the sole benchmark of success. Modern banks are expected to act as responsible financial intermediaries that actively safeguard environmental systems, promote social well-being, and drive resilient economic development. As its core, sustainable banking is an operational approach wherein financial institutions explicitly integrate environmental, social, and governance (ESG) factors into their strategy, risk management, and credit allocation processes. This goal far beyond superficial corporate philanthropy or public relations. It directly shapes how a bank conducts credit risk assessment, underwrites loans, manages investment portfolios, and designs financial products. Rather than chasing short-term returns that might fund environmental damage or social exploitation, sustainable banks aim to build long-term value for a broad range of stakeholders: customers, investors, local communities, and the environment. As global markets transition toward low carbon and inclusive economies, banks serve as primary capital allocators, funding clean energy, supporting ethical businesses, expanding financial access, and backing responsible capital instruments. The evolution of sustainable banking. Let us start phase 1 and phase 2. Sustainable banking did not emerge overnight. It represents an evolutionary journey across 4 distinct historical phases. Phase 1, traditional banking before the 1970s. During this foundational era, financial institutions focused purely on financial returns and basic credit risk management. Environmental and social impacts were considered externalities, completely ignored during underwriting decisions. Phase 2, corporate social responsibility, 1970s up to 1990s. Here, we saw the early origins of institutional responsibility, driven by defensive risk management, such as assessing environmental liabilities on contaminated real estate collaterals. Banks began establishing community initiatives and branches. This period also witnessed the birth of the earliest ethical investment funds. Let us come to phases 3 and 4. As we enter the 21st century, this evolution accelerated dramatically into structural financial reform. Between 2000 to 2015, the sustainable banking started. During this phase, ESG evaluation shifted from peripheral philosophy directly into core risk models. International voluntary frameworks gained widespread adoption, most notably the Equator Principles in 2003, which set global benchmarks for managing environmental and social risk in project finance. We also saw the issuance of the world's first green bonds. Phase 4, Sustainable Finance Era, 2015 up to now, catalyzed by 2 global developments. In 2015, the UN Sustainable Development Goals and the Paris Climate Agreement. Sustainable finance entered the mainstream. Today, central banks demand climate stress testing, regulators mandate strict ESG disclosure standards, and financial markets deploy sophisticated tools like sustainability-linked loans, green taxonomies, and artificial intelligence-driven ESG analytics. The triple bottom line: people, planet, and profit. To provide a structured theoretical framework for sustainable banking, we look to the triple bottom line (TPL) concepts introduced by John Elkington in 1994. This framework asserts that an organization's performance must be measured across 3 distinct pillars: people, planet, and profit. Let us unpack the first pillar, people or social sustainability. In a banking context, this pillar addresses how financial institutions impact human capital and society. It encompasses expanding financial inclusion to unbanked populations, ensuring non-discriminatory lending practices, enforcing consumer protection standards, supporting small and medium-sized enterprises, SMEs, and fostering diversity within bank governance structures. Planet. The second pillar is planet or environmental sustainability. This requires banks to minimize both their direct operational footprint and their indirect portfolio impact. Operationally, banks digitize processes to reduce paper consumption and transition branches to renewable energy. Strategically, they allocate capital toward renewable energy projects, reforestation, and green building mortgages, while actively restricting capital to high carbon or environmental destructive industries. Finally, we have profit or economic sustainability. It is vital to emphasize that sustainable banking does not mean abandoning profitability or operating as a charity. Financial institutions must remain solvent, capitalized, and profitable to survive. However, the economic pillar shifts the focus from volatile, short-term speculative gains to stable, long-term, risk-adjusted value creation that safeguards the bank's capital structure against systematic risk. When discussing sustainable banking, we must align it with the classic definition of sustainable development from the 1987 Brundtland Report. Development that meets the needs of the present without compromising the ability of future generations to meet their own needs. Why are commercial banks so critical to this vision? Because banks act as the engine room of capital allocation in any economy. By adjusting credit flows, pricing risk, and setting lending criteria, banks directly decide which projects get built and which businesses grow. When banks direct capital toward clean technologies, climate-resilient agriculture, affordable housing, and underrepresented entrepreneurs, they actively drive economic transformation. Because of their central role in the global economy, commercial banks directly contribute to advancing several United Nations Sustainable Development Goals, SDGs. SDG 1, no poverty, and SDG 8, decent work and economic growth, supported through microfinance programs, financial technology adoption, and supporting local business growth. SDG 7, affordable and clean energy, and SDG 13, climate action, advanced by funding wind, solar, and hydro infrastructure, as well as underwriting green bonds. SDG 9, industry, innovation, and infrastructure, and SDG 11, sustainable cities, driven by financing energy-efficient urban transit and green building projects. SDG 12, responsible consumption, and SDG 17, partnerships for the goals, achieved by enforcing ethical corporate governance and collaborating with multilateral development banks. Slide 10 Let us go to slide 10, drivers of sustainable banking, environmental regulatory. Now let us analyze why banks are making this transition. What are the primary catalysts driving sustainable banking worldwide? First, environmental drivers. Climate change presents direct physical risk, such as extreme weather damaging, collateralized property, and transition risk, where sudden policy shifts render high carbon borrower assets obsolete. Banks must adapt to protect their loan portfolios from severe credit defaults. Second, regulatory drivers. Central banks and international regulators are rapidly changing the rules. Financial institutions are now legally mandated in many jurisdictions to publish detailed SDG disclosures, conduct climate risk stress tests, and align their lending portfolios with national green finance taxonomies. We are also seeing powerful market forces to play economic drivers. Institutional investors are redirecting capital away from ESG deficient assets. Banks with strong sustainability ratings benefit from lower funding costs, superior credit ratings, and access to rapidly growing pools of ESG dedicated capital. Social drivers. Public awareness has risen significantly. Today's retail consumers, businesses, and job seekers actively prefer financial institutions that demonstrate genuine social responsibility or fair lending practices and commitment to financial inclusion. Technological drivers. Finally, technology and capital market dynamics are providing significant turns. So technological drivers where modern fintech, artificial intelligence, and big data analytics allow banks to evaluate Scope 1, 2, and 3 carbon emissions across their underwriting portfolios with high precision. Furthermore, digital banking lowers operational energy consumption while bringing banking services to remote and unserved population. Investor drivers. Global capital markets have seen an unprecedented surge in demand for green, social, and sustainability-linked debt financial instruments. Banks that embrace ESG are better positioned to attract long-term capital. Now, my students, you have self-assessment and review question. To consolidate your understanding of today's lecture, let us ask you to go through a quick self-assessment exercise. I encourage you to pause the video here, read through these statements, and evaluate whether each is true or false. Thank you. Thank you for your attention and engagement throughout this session. Please review the readings and case studies uploaded to the university portal. In our next lecture, we will build on this foundation by examining the specific mechanics of green bonds and sustainability-linked loans. Have a great day.